Welcome, everybody, to the Blind Ambition with Jack Kelly. It's Rick Chen from Blind, and today I have Wayne Hugh from SignalFire. SignalFire is a data driven venture capital firm known for being structured like a tech company with a CEO, heads of talent, and go to market, plus engineering and tech teams. Half of the team actually have degrees and experience in artificial intelligence or machine learning, and the firm is talent driven, which makes sense as it originally started as a stealth AI tech recruiting platform before creating a new venture capital model. Wayne, he was a partner at SignalFire, and he leads the early stage venture fund focused on consumer, emerging technology platform shifts, and industries ready for major shifts in innovation, such as healthcare and fintech. Before joining SignalFire, Wayne was the global strategy lead for YouTube ads monetization and responsible for the go to market strategy for Google's now multi billion-dollar video ads business. He's also an alumni of Kleiner Perkins. Thanks for coming on the show, Wayne.
Thanks for having me, guys.
A pleasure. That's a great background, huh? What a pedigree.
I mean, I hope you don't mind. Like, if we can dig into that pedigree, how does one become a venture capitalist, right? Like, it's now a hot job that everyone wants to get into, and I'd love to pick your brain there.
Yeah, happy to. I think the answer's changed a lot since when I first started in venture. Back then, there was no playbook whatsoever. And so one of the things that I and many others had to do is volunteer for these funds and do projects kind of for free in areas where maybe you had some expertise that lined up with areas that the firm wanted to invest in. And so, I had done work in education as an administrator for the CCC, which is like a large post-secondary school set of schools in Chicago. And I offered to do basically free research for Bessemer back in the day when they were just starting to build up a bit of their ed tech portfolio. I did something similar with Kleiner too, where I'd done some work in McKinsey Global Institute on the future of energy demand. And they were doing a lot of clean tech investing at the time. This is sort of like clean tech investing wave one before kind of the resurgence over the last year or two. And they, there was a very large energy macro component to a lot of the investments they were making, which intersected really well with the research I'd done. And a lot of the partners, I think, had read some of the research that I helped author. So that was kind of my entry point into venture back then. And I would say that, that's probably fairly representative because, most of these funds, they were just starting to hire, one or two junior people, not doing job postings, by and large. And so there was a lot of serendipity and kind of networking, volunteering to kind of get your foot in the door back in the early days. I think now you have funds that are so large, with like 20 billion under management or more, that they operate a little bit more like banks, where they have kind of a recruiting process. They may come to different campuses and hire a large number of people out of consulting or banks, just like other large employers do. So I think that's changed a lot. There still is, if you're interested in seed and very early stage investing, I think it's still a little bit kind of old school, like in the way that I mentioned, but certainly on kind of like the late stage investing side, which has just exploded, over the last 5-10 years or so. That's become much more institutionalized.
And what is an early stage, like entry level position at a venture capital firm look like? Is it research? Are you a scout looking for companies? Or are you actually, sitting in on the investor meetings or pitch meetings?
Yeah, it depends a lot on the firm. I would say for early stage, by which I define like a lot of seed stage, Series A investing. Series B is generally kind of where I personally would cut off. You're starting to get in kind of growth territory. For those funds, a lot of it is trying to build networks so that you can source new companies for the firm. I would say that if you are joining a very large growth-oriented fund, you're going to be doing a lot of sourcing as well, but there's a lot more time that you can spend in diligencing companies. Given that at that stage, companies, there's a lot more meat to kind of dig into. as it relates to the company's financials, the market history, their competition, et cetera. And so I think that's why, if you do have like a year or two of banking or consulting experience, late stage tends to be a more logical entry point versus, just jumping right into early stage, where, a lot of cases you're just investing in like two people and a dog, a PowerPoint idea. And that is, that's something that's a little bit more intuition based, a little bit more network based, and something that, one needs to kind of build up over time.
How is it now? Because it seems that the VC space was on fire. Every time you look, you'd see a new unicorn company pop up. And now you're seeing the opposite. You're seeing, probably more layoffs in the tech space, in the crypto space, in the startup space, than even in other places. Is there a pause now in the VC world, or how's it going?
Yeah, VC, for sure, it's been shaken by what's happened in the public markets. What I'd say is there's a few things going on. Number one, you had a number of really aggressive crossover funds like Coatue, D1, Tiger, et cetera, that came in and deployed unheard of amounts of capital into late stage investing. And a lot of those folks have been hammered on the public market side, which has then kind of spilled over into their private markets investing. And so a lot of those folks have pared back in a really big way. And I think that has carry-on effects kind of down the stack into, from kind of like pre-IPO, very late stage, into Series B, Series A, and seed, and so forth. I would say the shocks get less and less acute, if you will, the farther away you get from kind of late stage and public markets investing, such that, at the very late stages, you may have what feels like a complete freeze, in investing at the very late stages. I would say at the Series A and Series B, you definitely still see a reduction in activity, but it's still getting done. So, call it like a 30-50% reduction in activity. And then by the time you get to the seed stage, that is the least impacted. I'd say activity has still fallen, maybe, I don't know, 10-20% or so, but it's still, there's still plenty of great founders, getting seed money.
Now, with interest rates rising, so Powell wants to beat inflation, cool down the economy, higher interest rates. Does that have an impact on money raising for the VC firms where you can't get that cheap capital?
Yes, 100%. I think you're going to see a lot of, especially the newer funds who haven't had time to build a track record yet. Those funds, if they have to come back to raise in the next year or two, assuming the market is still depressed, they're going to have a really hard time fundraising. I think we saw, I can't remember how many, there's something like, 500 new funds in the last year or so. Those, you're not going to see those numbers again.
Well, 500, just
time.
compare like 500 last year compared to, let's say, pre-COVID, like do you know offhand, like how much it increased? Because 500 seems like a lot. I don't know the space, but it does seem, right? Rick, it seems like a lot.
I don't know offhand, but it's felt to me like a 5 or 10x explosion in the number of new funds since I started in the industry.
Wow.
For sure. Yeah. So those funds, I think there's going to be a flight to quality at times like this. LPs are going to be slowing down their deployment into funds and kind of digesting the commitments that they've made, because they've been pushed to put so much into venture and pressure to do so. As like a lot of these tier one funds have all fundraised at a very similar time. And a lot of the LPs have been worried about losing their seat at the table if they didn't commit, right? And so they've committed a lot of their funding in a very short period of time. And they're very happy to kind of, let that kind of sit for a year or two before they can, start kind of making new commitments. So it's going to be a pretty tricky time for fundraising in the VC world, for sure. That said, we still have record record levels of funding sitting on the sidelines right now, right? With like Lightspeed, I think announcing a multi-billion-dollar fund. I think Andreessen announcing like an almost $10 billion fund, somewhere in that scope.
Well, speaking of Teresa, how are they big? Like, how are they putting money in Adam Newman from WeWork? Another like 350. It's like, all right, you guys just went crazy, but yeah, take another 350 million. How does it work in that environment? Because like in corporate America, it doesn't really work that way. Like, hey, Rick and Jack, you guys just like went nuts with the money we gave you, so we're not going to give you money anymore. But the VC's like, yeah, here you go, take it. Can you kind of explain like what goes on behind the scenes?
Yeah, I can try. I'm going to caveat that and say like that is that's as far away from what I do as possible.
Yeah.
Like I'm generally doing like $1 million or $2 million
Right.
into seed stage companies. But if I can kind of try to get into their mindset, number one, real estate is an absolutely enormous market. You could argue one of the maybe 2 or 3 biggest markets in the US by kind of GDP. And it is still very much broken. So to the extent that you can build companies there, outcomes should be enormous. And when that's the case, a lot of times you can justify pretty massive entry prices. If you can really build the next Google or Facebook or $1 trillion company. That's number one. Number two, on Adam himself, I think a lot of people, there's a lot of publicity he's gotten around his behavior, his mismanagement of the company, the fact that he's taken a lot of money out of WeWork before it kind of crashed and so forth. But he did invent a new category, sort of a new consumer behavior, right? He's the first to kind of introduce brand into kind of this notion of kind of fractional commercial space. And it solved a real need for a lot of people, a lot of small businesses, a lot of people who are looking for, a place to work. And there's no question that Silicon Valley is littered with people who have exhibited at times questionable behavior. Let's put it that way, for the sake of innovation. Whether it's Travis Kalanick, whether it's Zuckerberg, whether it's like Mark Andreessen himself, at Netscape. I'm sure there, or like a Sean Parker, right? Who eventually kind of referred the Facebook deal to Peter Thiel. This is the world of innovators and rule breakers in a lot of cases, and sometimes it takes a little bit of that to really really take the kind of extreme risks you need to build the next Google. So that's and then number 3 is they raised, don't quote me on the exact, I think it was like a $9 billion fund or something like that, Andreessen. And so 350 million in the grand scope of things is actually a small part of their overall fund. So don't get me wrong, this is not the style of investing I do, but those are kind of the 3 reasons I could imagine that would justify for somebody like a fund like Andreessen to make investments like this.
So what do you do? Like, how's your specialty? How does it differ?
Yeah, we SignalFire is focused on seed early stage investing, which is, for our fund size, we're deploying out of a $200 million seed focused fund right now. Obviously a $350 million check would be more than the entire fund. So our average check size would be, I think, roughly in the $1 to $2 million range. Going up to like 4 to 5. And at the end of the day, our strategy is backing amazing founders, going after enormous visions, but hopefully not in areas that are as capital intensive as real estate, where somebody like an Adam Newman needs to buy, maybe he needs 350 million to buy that much property, to scale whatever he's doing. We're generally not doing investments of that sort. And then I would say the broader strategy for SignalFire is, given we are a tech company that has built an engineering team, shipping products that actually help our founders, we tend to have a really strong bias for data-driven companies, very technical companies, builders who, like us, often using similar tech stacks as us, maybe employing a very similar model to changing industry, like SignalFire is doing within venture capital.
That makes sense. I mean, your focus on the firm's focus on financial technology, real estate, these are industries that badly need your help, badly need technology, badly need some kind of innovation. Um, I kind of want to dig into the investment thesis there, right? Are there any kind of portfolio companies that you've invested in recently that you think are particularly exciting that might be a good preview for the blind community of kind of trending industries or trending companies?
Yeah. One of the last publicly announced investment that we made was a company called HealthNote, which is in the it's an awesome company that's going after the physician burnout epidemic. If you have doctor friends and you talk to them, all of them will tell you how much they hate their EMR and how much of a time sink note taking is. And so this company is they've built a patient intake workflow where instead of just asking patients just for their medical history and other kind of basic information you need for medical billing, they're asking clinically relevant questions, right? Like, why are you coming into the doctor's office? And then based on your response, actually, making dynamic kind of follow-up questions to dig into, what's actually going on with you, in the same way that a doctor would. And as you can imagine, that's much trickier and much more difficult to instrument, depending on the specialty and exactly, and the hospital system and so forth. But once they've gone through that work, they can auto-populate notes directly into the clinician workflow on the EMR side, which is very much, kind of like that one-to-one time savings that, that doctors are, talking about. And that is, that's a massive practitioner enablement piece that we were really excited, to see somebody actually solving. It's, as you can imagine, it's like front and center for all of these areas where you have such massive kind of supply shortages on the clinician side, massive, burnout epidemic, as I mentioned. And it's also extremely strategic for all of these massive EMRs and EHRs, which are competing for, in many cases, hundreds of millions of dollars of accounts for like these massive, providers. And the differentiator in many cases is clinician feedback, because, it's just, they just hate all these systems so much. And so this is, that's, I think, an area that we really, we're really interested in, and we really got an inside look through some of our team members, which includes, venture partner Eric Larson, who's Chief Strategy Officer at United Health. So he has kind of a window into, how this is thought of at the biggest, medical providers in the U.S. And folks like David Clements, who we brought on as a venture partner on our team, who sold an EHR business himself for multiple billions of dollars. So that's what we're excited about. We're generally very excited about healthcare over the economic cycle. It's one of these areas that's very kind of recession proof, and we think, is probably is going to undergo kind of a massive transformation over the next few years.
I mean, would your recommendation be to technologists that are concerned about the recession? They're seeing once high-flying companies like these Bitcoin, Web3, cryptocurrency companies like Coinbase and Robinhood sort of struggle right now. Should they kind of hop into these quote unquote like more recession-proof or even boring, some would say, industries right now?
Yeah, in terms of investing on the private market side, which, that's the only part I'll comment on. Yes, I think that's been our tack for sure, is to not invest in capital intensive industries at the moment, or capital intensive business models in sectors that are likely to have their end customer base impacted very heavily. And instead go for areas like healthcare, like cybersecurity, et cetera, where you tend to see very, very consistent demand through downturns, or in many cases, actually an increase in demand.
Got it. So the healthcare in a pandemic, that would make sense in terms of increase in demand, right?
Yes. Yeah, 100%. Like in area, I'll highlight one area specifically in healthcare, mental health, right? During times like this where it's very stressful, I think demand grew 200% during the pandemic. And at the
Wow.
same time, supply on the clinician side, grew very, very slowly. I think 55% of all US counties don't have a licensed behavioral therapist.
Wow.
Yeah, so that's an area. Those are areas in healthcare, and there are other sectors as well where if you can if you can corner clinician supply or help enable clinicians to be much more productive, I think you can have a huge impact.
I'm kind of curious. How does one collect these kind of insights about these industries that you might not have any clue in, right? So, say you're an engineer, you're a technologist, you're working at a startup, maybe even got laid off. How do you discover these insights? Like, oh, healthcare could actually be really booming, or um, mental health as a category has this incredible need that I can perhaps hop in as a technologist and help optimize or make more efficient.
Yeah, yeah, I think venture capitalists, I think one of the things people are surprised to learn about it is a lot of VCs spend about 3 to 4 hours a day reading, just consuming information from
Huh.
newsletters and other online sources and so forth. The and so I think that's a huge piece of it, is filtering across a lot of that, which is a lot of it is noise, but being able to kind of like cherry pick interesting tidbits, for further inquiry. I think that's one piece of it. And the second is, we have the privilege of learning from the smartest people out there who are on the bleeding edges of learning about up and coming markets and so forth. And that's the founders, right? And so if you're meeting with tons of founders who are really the ones, boots on the ground, learning a lot of these core insights, you're in the privileged position of being able to aggregate a lot of those insights.
Are there any other things that people might not know about venture capital as a career? How's the total compensation? Is it quite high? Is it one of the lucrative things that we all kind of expect or assume within finance?
Yeah, there's a lot of myths about venture capital, and I think one of the biggest is that there's the image of the VC on a yacht during the summer, kind of spending all their, or buying vineyards in Sonoma and relaxing, while kind of like the founders are hard at work, and it is true. In my opinion, like nobody works harder than founders, but VC in general is actually if you're a new emerging fund manager getting in the business, it's probably the worst job,
No.
from a compensation, money, financial standpoint, versus anything else in finance, whether it's private equity, hedge funds, working investment banking, or what have you. And the reason is, number one, the fund sizes are so much smaller, right? If you're starting off, you raise like a $10 million fund, your typical, on average, you're going to draw a 2% management fee. That's $200K, right? You can't, and you're going to have back office support costs, like all sort of administrative costs. You really can't support much on that. The second reason is, even if you start to raise successively larger funds, there's something called a GP commit, which means that you have to put in, as a show of faith, a show of strength, you have to put in at least 1% of the fund yourself, as a partner. And so if you raised, $50 million fund, you'd have to make good for, call it 500K. In the context of, like I mentioned, only being able to pay yourself, I guess for a $50 million fund, call it like 2 million for staff fees, administrative costs, et cetera. There's really not much left over, if at all. And in fact, if you are on this path, in many cases, as a partner in one of these firms, venture capital might be like a negative cash sink for you before you actually make any money on the back end, on the carry, which is the upside associated with financing startups. That's really where the big money is. But if you're funding companies at the seed stage, it can take 10 to 15 years for companies to go public. So in the meantime, during that decade, you might be sinking a lot of money, into your funds before you ultimately get that big payoff. So, that's to say, like, there's plenty of money in venture. Lots of folks who are successful can make a ton of money, no doubt. But in many cases, especially for kind of the little guys, emerging fund managers, it's one of the least lucrative jobs financially for quite some time.
That has to be brutal. So if you're in that seat and you're a year, 2 years, 3 years, 5 years, grinding it out, not making money, putting in your own money, waiting for something to hit, and maybe it will, maybe it won't. That's a tough life, right? That's like, you're just living, it's almost like you're gambling big time, hoping to get that big score.
Yeah, there is, I think certainly for like emerging seed managers, you have to be comfortable with risk taking for sure.
So, but what do they do in the meantime? Do you have to have this? Do you try to have an Uber and make ends meet while you're in VC, or you just have to come into it having money to say, okay, I don't need that cash flow right now. I have enough in the bank, and I can live off my savings. And this way, I could take that big risk to get that big reward. Is that what happens?
Yeah, most, at least historically, most new funds were started by experienced operators who kind of, they probably have a war chest built up.
So they have enough money. It's
Google,
more now
being somewhere senior at Google or a successful founder or what have you. I would say though that creates a barrier such that new fund manager, it's very hard for like very young people, especially underrepresented folks within tech to start funds. No question. There have been folks who've gotten around it by not making a full GP commit in agreement with their LPs. So at least they're not like sinking their own cash, the 1% into these funds. Or I think that there are banks that can help with that too. I think SVB may be able to kind of like give you a loan to help you out with that. But nonetheless, it's no question, it's a tough place to be. Now, that said, you're probably not going to raise funds from LPs as well unless you have some sort of track record. So it's unlikely you'd be able to do, to get the fund off the ground in the first place anyways. If you're like super young, you haven't really done a whole lot yet.
Got it.
Yeah, I'm sorry, go ahead, Rick.
No, so I imagine that's why you're seeing some of these like early venture capitalists kind of start as almost alumni networks, right? So it'll be Airbnb folks investing in other folks that used to work at Airbnb or Stripe or Uber, etc. Where perhaps you kind of have that built-in network, almost like a cheating effect.
Yeah. If you're raising a fund, it's a little bit like raising money from VCs as a startup, which is to say, you need to have like a unique insight and a fantastic team. And in those cases, at least for Airbnb and other alumni networks, you're at least coming in with like a pre-baked network that can source you deals, right? Some unfair advantage because, as we mentioned, if there are hundreds of new funds being started, last year, you got to have some way to stand out.
Got it.
Oh, wait, for the last year, it seemed from the outsider perspective that venture capitalists would choose a sector and just throw gobs of money at it to try to just kind of own that piece and then kind of rinse and repeat and then go to another sector, another sector, another sector. Is that my imagination, or is that kind of the thought process that was going on? Yeah,
this is one of the funny things of venture, which is I think everybody's taught to be a first principal investor. That's the only way you can make money is being right and seeing things before other people, right? Because as soon as it becomes consensus, all your returns get arbitraged away. Everybody, deals get bid up to the market, and your returns are gone. So that's something that an axiom that keeps getting passed around, but in practice, there's a lot of herd following mentality and behavior. And I think, part of it is, number one, this is just such an information sparse environment. When you're investing in companies that it's just an idea, a couple people, a thesis, there's just not a lot to hang your hat on. And it's really hard to avoid the social validation of tons of top tier funds trying to get into this investment, right? And certainly on a short time frame, that seems to be the clearest predictor of success is how much money other top tier VCs are putting on a company. Like I mentioned, it can take a decade or more for a company to actually exit, go public, sell, etc. And so you're looking for any sort of feedback signal that a company is doing well before that. And the clearest one that you can see, at least externally, is whether or not smart, big brand name VCs are pumping a bunch of money into companies. So I think that tends to reinforce to other people in the ecosystem to kind of try to, chase the same deals. That's one piece of it. The other piece I would say is, I actually think that there's probably a few like structural reasons that we would read about a lot of similar companies and spaces getting funding at the same time. And that's, a lot of these companies tend to announce around the same time. If you see one of your competitors announce like a massive round, I think some of these other companies tend to do, come out of the woodworks and announce their fundings as well. And it also encourages a lot of copycat startups to come up. If you see like a bunch of like massive companies getting tons of funding in this area and you're like, I could do something like that too, or like I think I could build a similar business maybe with a different approach. It tends to spawn a lot of other companies in those spaces, which of course get funded by the hundreds of new funds out there. So I think there's probably a bunch of reasons why this happens, even though in practice what you're trained to do as a venture investor is to be a first principle thinker and be very independent from what other people are other people are thinking.
And it seems it's distorted. It went the opposite. It became FOMO, right? It's like, okay, all the big VCs are in this, investing in X. Like, holy shit, I got to get an X. I got to miss out. I don't want to be the one where they say, oh, how did you do an X company? And like, oh, I didn't get in, or I didn't get involved. So it's almost like, but it doesn't mean it's a good investment. It just means like they're following the herd to go into this place and just putting a lot of money and just pouring a lot of money in there. And can't that also be a problem if, let's say, you put in 100, 200 million to this company, they really just have an idea? Isn't that problematic too? Like, how do you not just waste it? Because I wonder this. Tell me if this makes sense, Rick. Wait, could it be also possible with the layoffs that we're seeing in the tech sector startup is that you get 100 million, 200 million, crazy amounts of money. So what do? You hire people because you have all that cash and you're not really sure what you're doing with it. And in a different kind of environment, you're going to be more careful what you're going to do. But it's easy. Hey, all right, we got this. We got a mountain of cash. Let's keep hiring. And then when the things start getting a little cold, a little bad, they look around, go like, what is everybody doing here? Do we really need it? And it just becomes easy to let them go. Is that from someone who's from the outside looking in? Is that kind of what happens?
Yeah, there's no question that the logical thing to do as a business is to really nail it before you scale it, so to speak. Right? You want to find product market. You want to make sure you're building something that people want, and you've got like a good go-to-market motion to sell it before you start hiring a bunch of people and just and start scaling a really expensive org. Because a lot of these companies tended to raise ahead of their skis. I'll point to a lot of like the SoftBank rounds and so on and so forth. A lot of these the companies were pressured to build their organizations and spend money ahead of where the reality of the business was, given their stage. And that's a very dangerous place to be, because now you have all that headcount, all that cost, and you don't have the fundamentals to support that. That can be, and I think that's when you look at a lot of the biggest the biggest company blowups over the last few years. I think that's a situation that many of those companies unfortunately felt they were in. So yeah, no question. There are some businesses that are inherently very capital intensive out of the gates, right? Think of like deep tech companies that need to invest tens or hundreds of millions into research before they can actually, get a product out the door. A quantum computing company, or maybe even a capital intensive business that needs to buy assets before they can actually get to market, like Adam Newman's new company. Maybe that's just
Right.
inherent in the business. So, there's a distinction, I guess. There's a couple kinds of businesses, some that really do require that money just to get a product out the door. Not the kind of businesses we're generally investing in, because that's very risky, in my opinion. But there is a second class of businesses, like you mentioned, that probably didn't need to spend that much money to actually test the market and develop something that customers would want before they scale up.
Wait, dude, it drives me crazy because I'll get these pitches, and a lot of times I write about these companies, and I'm thinking, you know what, give me a quarter of that money and I can make this work. You don't need all that money. What are you doing? You're just getting out of control. And then when I'll see resumes, when people either are leaving or been downsized, and you're looking at their resume like, this person wasn't necessary. I'm sure there's a great person, a smart person, as a human being, but given where they are in terms of their maturity of a company, I'm like, you don't need that person to do this. It was just almost like the manager wants to pat their own ego and have a whole little staff to make themselves look important. So they're going to hire a whole cadre of folks who are, going to be running around doing things, but it's not really moving the ball forward. At least, again, this is looking from the outside. And then when you were talking about, kind of the follow effect, I think I may have written 3 pieces for Forbes about the Super Bowl and how these, workplace kind of companies were investing like $5 million to be, in the Super Bowl for like a 30-second spot. And like, I'll tell these guys, dude, what are you doing? Like, you save the money for a rainy day. Maybe I'm just like a cheap old fashioned guy. I'm like, I get it. You want to be in the Super Bowl, but what if something goes wrong? That $10 million could help you out. And they're like, you don't know what you're talking about. You're crazy.
Yeah, I think it's hard for me not to have the same instinct, but $10 million could be a drop in the bucket for some of these companies, given their stage, number one. And
True.
Some of the, because there's less competition, at least from tech startups, for some of that kind of advertising, like TV advertising, events-based advertising, billboards, etc. Sometimes they can be cheaper, much more effective than you might think.
I found out that
it's hard to measure. Like that stuff is very hard to measure. So it's
I think I just read recently, where in Times Square they'll have a big billboard with everything on. I thought it was a whole lot of money, but I forgot a couple of people saying, "Oh, hey, we rented. It was only this." I'm like, "What?" I think I want to do that just as a vanity thing to goof around.
Yeah,
it really wasn't that expensive, but you do get a lot of attention.
Yeah, that is. I know exactly what you're talking about, and that thing is. I think it's on the order is much cheaper than people
then you would think it would be
like
right?
tens of thousands kind of thing.
I forgot what it was, but it was
Wow.
something like, oh, I can just as a goof to say Jack Kelly, whatever does this. Like, all right, that's pretty. But the Super Bowl, that's a little different because Super Bowl. I'm thinking this. All right, how many let's say guys are sitting on their couch drinking a beer and saying, "Hey, I want to know about my workplace productivity software." I don't know. I don't know if that's money well spent. And I'm not casting any aspersions on them. I'm not being a jerk. It's just trying to kind of put the pieces together and understand how this whole ecosystem works.
Yeah. You're right about one thing, which is up until this market crash, it has been a growth at all cost mentality, for a startup. And it rots from the head in that, VCs the markets are prioritizing growth, right? You just look at the enormous growth premiums for companies, raising at 100x revenue, 200x revenue, if you are kind of a high flyer who's growing quickly. And in that kind of environment, you're willing to spend whatever it takes to get to that growth, And so I think that incentivized a lot of, suboptimal behavior, and inefficient spending.
Yeah.
Which has a lot of carryover effects because lots of people are getting hired, lots of people are being hired into businesses that may jobs.
So you can see a hangover effect where maybe the companies that were more prudent had a decent raise, have money in the bank, they didn't spend like drunken sailors, they were holding on to it, and they could last. And the ones who just like burnt through it and they're going back to, their VCs and saying, hey, we want more. And they're like Sequoia, put out that letter saying, hey, tighten the belt, buddy. This is going to be tough times. So do you think you're going to have the shakeout where the ones who maybe, what is it like, not the tortoise and the hare, but the rabbit or whatever, whoever's conservative and stored the nuts for the winter, they're okay. But the ones who didn't and spent all their money, they're like, sorry, you guys are out, and maybe they'll just get their technology acquired and that's it. Do you think this is going to be this kind of play out in the next 3 to 6 months?
Yes, absolutely. I think
you seem happy about that. So wow,
it's a quick answer.
In some sense, it's I think it's long-term healthy for the ecosystem for the shakeout to happen. You have, I'll just give you a concrete example. The classic Series A of the last few years raised like 20 million on $100 million valuation. A company with like $1 million in revenue, right? If you look at the public market comps today, you're raising at like they're being valued at like 4 to 5x, forward revenue. That means that $1 million SaaS business has to then grow from like, call it 3 to 10 over the next year with a story to go to 20 just to raise a flat round. And most of those companies are not going to go from 1 to 10 in 2 years and have enough money left over to fundraise at that point. So I think there's going to be a massive shakeout of companies who either they're just going to have to accept down rounds or, and layoffs, or gotta go out of business. So I think we are in store. And by the way, this is much more acute at the later stages. I think, there are lots of people who believe that, at least half of unicorns, of which have exploded over the last few years. These are unicorns that, companies valued at $1 billion or more. At least half of those companies may go out of business. So I think it's definitely, now I'm not happy to actually see founders' life work and so many people go out of business, but I do think that those were unhealthy market conditions in the first place. And I think that it's probably a healthy reset where we're coming back to normal now, as opposed to having some, deep punitive recession where, it's like a terrible time to build tech startups. If anything, I think we're resetting back to, what was a more healthy market environment, kind of call it a decade before.
No choice, right? Because if you don't have that cheap capital now, because with the interest rates, the way Powell is going to have it, you're not going to have access to that money to just like you did before. So there's no way they're going to keep that funding coming in at the level it was before. So they're kind of stuck. They're in a bad space.
Mm-hmm.
And I got to tell you, covering these and writing about these and folks and speaking to them, great people, smart people, wonderful people, same thing as you. You don't want to see them, in a bad space, but it just didn't make sense a lot of times. Like like you're saying, the amount of money they raise, the amount of money they're spending, the revenue or lack thereof, profits, forget about profits. Like, wait, this doesn't add up. Like if there's a a crypto winter or something that goes wrong, there's nothing there to save them. And it was just always to me, again, looking from the outside looking in, it's like, that's such a, wow, you got to have big, excuse my language, big balls to take those risks, because like it could go wrong so fast. And I didn't make, I couldn't process that, because like you would think that there would be some, safety nets, but I guess that's not how it works. You swing for the fences, I guess, in this space.
Yeah.
Right?
Yeah. Look, to build really massive companies, you have to take risk.
Yeah.
And a lot of companies, unfortunately, have been pushed to or incentivized to take more risk, and that's appropriate for the company stage, to grow at all costs. And so I think that you're 100% right that the companies that maybe thought from first principles about what's the most efficient way to build an enduring, sustainable business, those are the founders who are going to do disproportionately well over the next cycle.
Which is good. Like you're saying, in the long run, I think this will be really healthy because it's going to make the VCs and the people who are writing the checks say, wait, I'm not going to follow the herd like I did last time right off the cliff. I'm not going to be a lemming and go right off the cliff and it's going to be horrible. Let's see, let's break it down. Are you getting any revenue in? What's the profits? Let me look at the books. Let me make sure it's a sound business, and really kick the tires and not like Tiger, just write the check. Here you go. All right, let's see what happens.
Mm-hmm.
And then we're down 60%, 70% for the year, something like that.
Yeah, something crazy. It's, the other dynamic I'll point to is so many VCs over the last, 5 to 10 years are completely new to the business and they've never seen a downturn.
See, that's what I think it is.
And if that's the only world then, it's going to be institutionalizing your behavior to some extent.
Dude, I think, you hit it. Rick, do you see this like on Blind where, I'm probably a little older than the folks on Blind, and I've, saw from the dot-com boom and bust, 9/11 and the after effects, the financial crisis and so on. And I remember talking to my dad about, when they had it's this October crash in 1987. So like I invested just my own money, whatever I make.
Oop, Jack, did we lose you? Wayne, do you hear me?
Looks
okay?
like it. Yeah, I can hear you fine. So I think Jack must have lost his connection.
Oh no.
All good. I think he was talking about his personal experience and kind of living through many ups and downs and his own investing behavior. But I would say that for most investors who joined venture capital over the last 5 years, the ones who made the most money were the ones who piled into the sexiest names at almost any price. And so it's a behavior that was self-reinforcing in many ways. If you really wanted to, and of course, you're talking about venture careers where the average, it's possible that, 80-90% of investors are gone after 2 to 3 years, where the actual outcomes happen 10 to 15 years later, right? So there's a little bit of a disconnect on what do I need to show, right, to show that I'm a good venture investor, well ahead of companies actually, realizing money, right, returning money to investors, and in that market environment, it was a pretty lucrative strategy to just pile into these really sexy names that continually get marked up. So it was, on some sense, rational behavior for people to do this. And then, of course, all of that had a knock-on effect to the companies themselves to grow at any cost and be one of those sexy names to get valued, at 100. So that's the kind of world that we had lived in. And that's part of the reason why I think this is such a healthy reset for everyone, for companies, founders, and investors who are now learning hey, let's actually prioritize, unit economics, profitability, things that, you might think are
basics.
It sounds silly to you, very, very obvious, but it wasn't, for all the reasons I mentioned, it wasn't necessarily the case for many years.
I mean, I wonder if there was this sense of, oh, the market is so hot. I know later on, Tiger or SoftBank or all these other folks are going to bid it up. And so maybe even on the seed or early stage, there's a loosening of diligence, right? Because you're just hoping that later on, oh, well, these startups are going to have to raise every 2 years or even 3 years. And these later stages are going to bid it up. So I can, tell my LPs I did well, right? We have these unicorns now, or, SoftBank is on the balance sheet now, right?
Yeah. When you invest in private markets, there's no market forces that hold you accountable to marks, if that makes sense. Nobody can short sell the stock. Nobody can freely trade the stock at a different price. And so if somebody out there is willing to market, like a Tiger or Cotu or what have you, is willing to market a company at, outrageous prices, it's going to, you're going to look really good on paper, if you're investing at the early stages. So yeah, it's I don't know, it was definitely excited to kind of get back to a little bit outside of that, because I think as an investor, if you are prioritizing kind of companies that have a pathway to profitability, much more sustainable, enduring businesses, you probably suffered on paper gains over the last few years. So I think this will be a welcome return for more disciplined investors, to put it that way.
Got it. I appreciate your advice and your insights into how like something that seems so negative, right? When you hear hiring freezes and budget cuts and layoffs and reset valuations or slashed valuations, even how there could still be a silver lining, right? Where we can actually see that the high quality companies and the industries and products that are worth having and using. So,
Yes.
thanks so much, Wade, for coming on the show.
Yeah. Thanks so much for having me.